Welcome to another Southbank Investment Bulletin. Now, the thing I wanted to talk about today is just trying to keep it simple. If we look at the 10-year yield in the USA, it's breaking out of this range that's been underway for most of the last year. And it hit 4.5% at the end of last week. It's still steady. And it looks like it's going to go higher. So I think the important point, though, is that there's a high degree of commonality in lots of different government bond indices. But the big outlier is the UK. And the 10-year yield in the UK is actually coming down. So it peaked and rolled over in the last month. So it hasn't broken down yet. It's still at 4.25%. And it's been, in fact, higher than the US 10-year Treasury is right now. But this doesn't look like it's breaking on the upside. This, at the bare minimum, looks like it's a consolidation in the region of the peak. And potentially, it's the beginning of a top formation. Now, we won't have confirmation that it is a top formation until the yield is sustainably down through the 3.5% level. But that's not an impossible potential outcome. Now, the important point, of course, is that yields go down when people start buying bonds. When you want to capture the 4.25% yield, you start buying the bonds. That means the price goes up, so then the return on offer is not quite as high, which of course implies that the yield is lower. And that's basically what this means. It's telling us that people are buying bonds. So if they're buying bonds, well, why are they doing that? And who is doing that? Now, if we look at the pound versus the dollar, it hasn't done much of anything but decline. So this is telling us that if there is demand for bonds, it's not coming from overseas. Because if it were, then we would anticipate there'd be greater demand for the pound. And this is a substantial break lower. So now this uptrend off the low at the end of last year is no longer consistent. It's pulling back inside the underlying range. And it's going to have to rally in a really quite profound manner in order to confirm a return to demand dominance. So what this suggests to me at least is that it's UK investors are buying bonds, and they are reasonably content with capturing a 4.25% yield because they're worried about growth. Now, when we think about what's going on in the UK economy, you have the Prime Minister rolling back the plans for a net zero policy. And I think that is just expressing some kind of rationality, finally, that it should at least be in some way or form, a democratic process. But of course, what it is also helping to highlight is the government is keenly aware that they need to curtail price appreciation, and they need to roll back the inflationary pressures that are existing in the economy. So that's one way to do it. And I think that's being rewarded by bond investors. They see some evidence that the government is acting to try and curtail inflation. Now, the FTSE 100 was in positive territory last week, and it's holding now in the region of the peak from a couple of months ago and potentially breaking the sequence of lower rally highs that's been in place all year. And of course, the big differentiator for the FTSE 100 is that most of those companies are very globally oriented. So a weaker currency makes their earnings look better. And that also helps to lend support to the nominal price of UK equities. Now, then let's think about, well, what's happening for the FTSE 250. Now, that is not internationally oriented. It's much more local. And here we still have the sequence of lower rally highs, and it has encountered resistance in the region of the 200-day moving average on several occasions over the last 2 years, and we're right there at the present moment. If the FTSE 250 is going to break higher, it will need to, at the minimum, sustain a move up through that 18,940 level. So it does have some work to do, but there is no question that if you have a smaller company and you want to expand internationally, a weaker currency is certainly beneficial. So when we think about why is the dollar so strong, well, it's clear that the Federal Reserve is quite keen to continue raising interest rates, and the Bank of England is less enthused about raising interest rates, and I think that is clearly a function of the difference between an economy that has predominantly fixed rate mortgages and those that have floating rate mortgages. There are legions of people that were able to lock in a 3% mortgage for 30 years in the last several years. They're not under any kind of burden from rising interest rates in the USA. We can't say that for countries like the UK or Canada or Australia or New Zealand, where they have floating rate mortgages. Every single interest rate hike, it just siphons money out of the pockets of the wider population. And then the only argument is that in the UK there's a large number of people who own their homes. So there, as a percentage of the population, it's not quite as high as one might anticipate that there are of the number of people that are actually paying mortgages. And I think that is the primary reason why the stock market has been reasonably steady. That it's I think the big fear that many people had was that there was going to be a crash in the stock market as consumer demand evaporated in response to this massive jump in the mortgage rate. But not everybody has a mortgage. So it is obviously a challenge, but it may not be the existential challenge that many people were fearful of. Now, of course, what we have to also prepare ourselves for is that if bond yields are starting to come back down, it's in response to fears about growth. And that the base case is if yields start to come down in a big way, then that would be in response to significantly lower growth and perhaps in response to a recession. And I think that is perhaps most acutely an issue in the UK right now, but it could certainly become an issue in lots of other places as well. And that's why I haven't been all that bearish on bonds, because I do think that when we think about what the likelihood is of a future recession, then the most likely scenario is that bond investors will be buying the dip, that they will be looking at capturing yields in excess of 4% because in a recession, interest rates come down. And then bonds start looking a lot more attractive, particularly relative to any other kind of risk asset. And I think that is something that we should be paying attention to, because bonds have been benighted and really have contributed to terrible performance for lots of portfolios over the last couple of years. But during a recession, generally bonds do attract interest. And of course, if interest rates do come down, well, then that is something that will be beneficial for the gold price. And then gold in pounds has rebounded quite smartly. So we're up now to 1570, and it is popped back above the 200-day moving average, and it's holding the sequence of higher reaction lows. This is purely a reflection of the devaluation of the pound. And when we do see interest rates starting to come back down, then that is when we're going to see a much more impressive performance from the yellow metal. I think with that, I'll leave you for the weekend or today, and wish all the best to all of you.